Thank you for tuning in today. And today we're going to talk about trailing stops. And the reason I want to talk about it now is because we don't know how 2021 is going to play out. Okay, but if markets start to move, it would be really great for you to have your own way of being able to take as much profit out of these markets as is possible. So I'm going to talk about a few methods that you can use to trail your stop. We'll talk a little bit about the difference between a stop loss and a stop limit order, and how these all work. So what's a stop order that's trailing? A trailing stop order, what is that? It's just an order that trails up or down as price evolves. So when price is rising, you're in a long position. That stop is going to follow using whatever technique that you've chosen to use. If price begins to drop when you're in a long, for example, whatever your trailing stop price is, that is the price that you're going to exit at. Now, trailing stops, they're not triggered until the market hits it. Okay, so like a limit order. But when that stop gets hit, it automatically turns into a market order. So if you're trading a market that's extremely volatile, you could look at some slippage and get filled at a worse price than your actual stop order. So does that mean they're bad to use? Are they good to use? Well, if you think about it this way, when you're trailing your stop, you're just allowing your position to stay in the market while the trend's ongoing. Okay, so if you use price targets, oftentimes you exit and then you just see the market continue in your direction. Okay, and that sometimes will cause a trader to jump back into the market, even if their trade plan does not have a setup. So if you do want the chance to ride that bigger trend, right, get bigger profits, a trailing stop can be your best bet. It depends on the trader. So how do you place it? Well, how you place it is going to be dependent on your platform, of course, and how you choose to trail your stop. Forex traders, for example, should know what a pip means in Forex and how your broker uses them. There's 2 after the decimal, sometimes 4, sometimes 5. You should know what your broker does. You can set automatic trailing stops with a lot of platforms, such as Oanda, which just update your trailing stop according to the criteria that you've set. But in order to understand how to place it, you should know the difference between what a trailing stop is and a static stop. So your traditional stop loss, that's the order that you set when you enter the trade. Okay, that's how you limit your risk when you take a trade. Now the stop loss is going to sit at the price you've set until either price reaches that stop level, or you take a profit, or you move it. So here I want you to note as price pulls back and makes new highs, the left side had the stop loss remain in place. Okay. On the right, as price increases, the trailing stop made its way under the new swing low as price broke upwards. So the benefit to that is you do take risk out of the market. So your stop out, if you do get stopped out, will be less than your original risk. Okay, that's barring slippage. And it could be profit. And number 2, depending on your initial risk amount, okay, you may have been able to book some profits before price comes back to your new stop location. So the biggest takeaway when you consider stops is that with a traditional stop loss, if price moves in your favor, your initial risk stays the same. A trailing stop is going to decrease that risk. Now just consider as an example, if you risked 50 pips in Forex, for example, and you have a profit target of 150 pips. Well, what do you do if price is 130 pips in your favor? Do you consider risking that 130 you've made plus the 50 in the stop loss just to gain an extra 20 pips? Okay, smart money says no, right? You're not going to let that retrace all the way because you're essentially risking all that gain plus your initial stop loss to make an extra 20 pips. So what's the best strategy? There's so many different ways you could do it. But the first thing I want to say is percentage-based trailing stops or a specific dollar amount. Not a fan of these. Okay, and all those are a simple X amount of dollars away or cents away from your current price, or a percentage of the current price. Okay, so for example, if I'm using a 25% trailing stop, that would mean if the current price is $10 and I'm long, 25% of $10 is $2.50. So my stop would be set at $10 minus $2.50, so $7.50. See, the problem is how do you come up with the price difference that you're going to use? Why are you using 25% as opposed to 20% or 15%? And it does not really account for extreme movements in the market. And it does seem easy to use a price base, and probably not one of the better trailing stop strategies to use, but it certainly would be better than nothing. So let's look at the first one, Bollinger Bands. And that way we get to use the volatility. So we could trail along the moving average, and some will say that you're actually using dynamic support or resistance. It's not really true, as the average just catches up to price. And using a moving average, it's better than just random placement. It's not something I would personally do. But what about using the average as a central location and then the standard deviation property of the Bollinger Band? Okay. By you doing this, we give the market some room to move, and we lessen the chance of being taken out before the move really starts. Okay, so assume that your trading strategy played consolidations here on the left, and the tightening of the bands on that left was your trading setup. So price breaks out, price rises, the lower band begins to rise. So on the close of each day, you'll find your new trailing stop price. Now you'd note the change in the price of the lower band, okay, and just adjust your stop accordingly. Now there's going to be times when the balloon effect of the Bollinger Bands happens, as we see it right here in the middle. We would not lower our stop, okay? It would remain the same until the band rises above the previous high point. Now the black arrows, that highlights the sections where your stop would continually change virtually every single day. So the technique on this particular chart is a daily FX chart. This was a 736 pip run before it got stopped out. Now some traders are going to have an issue with the times where price is way above the lower band. So you can experiment with lower band settings either by adjusting that look back period or the standard deviation setting. What about ATR? My favorite. We know markets go through times of low and high volatility. So if we use the ATR, we get to take advantage of the increase or the decrease in the range of price movement. So as average price range decreases, we may want to have a tighter stop due to adverse moves, oftentimes being pretty aggressive. When the average price changes and it increases, we want to give the market a little bit more room to run to take advantage of the volatility. Now, sudden price shocks in your direction, that's going to require a little bit more of an aggressive approach to trailing your stop. And we'll touch on that in a second. So the ATR trailing stop, it's going to take into account the volatility of the past X amount of days, whatever you're using. It's going to give you the average price. It also takes into account big and small price fluctuations. So you're staying in tune with the market. So this example here is just a 20-period ATR multiplier of 2, using the same chart as the Bollinger Band one. Look at the same type of entry. And as the ATR moves up with price, you're going to adjust your stop at the ATR value at the close of the chart period you're using. So this is a daily chart, so you adjust it after that daily candle closes. So now this calculation here is from the closing price. And you can adjust that to be from the high or the low. So if you're using highs for long trades, if you want to calculate your stop, you might want to consider a slightly higher ATR multiplier. Because if you don't, you may find your stop loss, depending on how large that price range is, inside of a candlestick. Now, what about those big price movements? Regardless of using price action or a volatility indicator, we're going to get these big moves that are pretty much outside that recent price data. So oftentimes you'll get gaps or large price moves. Well, that can actually spell the end of the current leg of price movement as an exhaustion, or in some cases, a change of direction of the short and long-term trend. So what do you want to do? I look at the gift the market just gave me. This is a 1-hour stock chart. And just for an example, assume you got into the lows over here on the left. So this trend channel shows the rhythm of the market. and strong price movement outside of the channel, that's something you want to note. Something has changed. So as you trail your stop up in line with the ATR, you draw those channels, the trend line channels. So if price breaks the high of the upper channel and stays there, you may want to change your trailing stop approach. Perhaps consider trailing your stop under the lows of each candlestick. That's going to ensure that you took advantage of that large move in price. In this case here, price gapped up and ran over 3%. What about percentage? We talked about this. There are some traders that do it. You can use the current higher closing price for your stop or the low, depending on what direction you're trading. You got to determine a percentage that you'd be comfortable giving back if you're in profit. So at trade entry, what is the maximum adverse move that you could handle in dollars before you'd want to exit? So you're going to need to determine what that percentage is. You might want to consider historical testing to determine the average move against the trend from both the trade entry location and when price is in your favor. The most common percentage that I've heard is between 15 and 25%. But keep in mind, the past has no bearing really on the future. I'm not a fan of percent-based stop levels. I prefer to use current market conditions. Now let's talk about trailing stops and stop limit orders. So a trailing stop order is going to trail below current price at a setting you determine, okay? So for example, let's say you bought XYZ at $50. You trail your stop $1. Current stop is now $49. The next day it's at $53. So now your stop is at $52. So if the market reverses to $52, your stop is triggered at the best available price, okay? Because it's now a market order. The stop limit order is going to be a little bit different. Using the same example, let's say you bought XYZ at 50. You set a stop loss of 75 cents with a limit of 25 cents. So if the market reverses and hits 49.25, you're only going to be filled because of the limit at a price of $49, which is 50 minus 75 cents or better, okay, because that's 25 cents. Now there's a danger in a stop limit order because if the market's dropping strong and sellers are panicking, you may not get the order filled and your stop loss could be huge. So trailing stop loss, while it's converted to a market order, will eventually get you out of the position. The limit order may not. Now let's talk about this because people ask this, what's the best one to use? There is no best one to use. What's important is that you do set a trailing stop if you're looking to make bigger gains in your positions. I personally prefer a volatility-based stop with using price action as well because I want to adjust for price moves that are outside the normal move. Now, using trend lines, they don't make too much sense because when price pokes below, for example, you probably want to be buying and not necessarily selling if you're in a long. The best trailing stop to use is one that you understand, one that's going to allow you to ride the trend, one that you're going to consistently use. That's the simple answer to that. Thanks for watching. Hope you liked it. Hit subscribe. Talk to you soon.